When someone decides to start investing, one of the first questions they face is simple but incredibly important. Should I invest in index funds or individual stocks? Both options are popular, both have produced millionaires, and both can grow your money over time. However, for beginners, the choice can feel confusing because the internet is full of mixed advice. Some investors claim picking individual stocks is the fastest path to wealth, while others argue that index funds are the safest and smartest strategy. In reality, the decision comes down to understanding how each option works and what type of investor you want to become. But before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. What are index funds and why are they so popular? Index funds are investment funds designed to track the performance of a specific market index. Instead of trying to beat the market, these funds simply try to match the performance of the overall market. For example, many popular index funds follow the S&P 500, which represents 500 of the largest companies in the United States. When you invest in an index fund that tracks the S&P 500, you are essentially investing in hundreds of companies at the same time. These companies may include technology giants, healthcare leaders, financial institutions, and consumer brands. Because your money is spread across many businesses, your investment becomes automatically diversified. Diversification is one of the biggest advantages of index funds. If one company performs poorly, the others can balance the loss. This reduces risk compared to putting all your money into a single stock. Understanding individual stocks. Individual stocks represent ownership in a single company. When you buy shares of a company, you become a partial owner of that business. If the company grows and becomes more profitable, the value of your shares can increase significantly. For example, investors who bought shares of companies like Apple Inc. or Amazon many years ago saw enormous returns as these businesses expanded globally. Stories like these often inspire beginners to try stock picking, because the potential gains can be extremely large. However, investing in individual stocks also carries higher risk. Unlike index funds where money is spread across many companies, buying a single stock concentrates your investment in one business. If that company struggles, your investment could lose significant value. Stock picking also requires research and discipline. Investors must analyze company earnings, industry trends, leadership decisions, and economic conditions. This level of analysis can be challenging for beginners who are still learning how financial markets operate. While individual stocks can deliver impressive returns, they require more effort, patience, and emotional control compared to index fund investing. The power of diversification. One of the most important differences between index funds and individual stocks is diversification. Diversification simply means spreading investments across many assets to reduce risk. Index funds provide diversification automatically. By investing in hundreds of companies at once, investors avoid the danger of relying on the success of a single business. Individual stocks, on the other hand, concentrate risk. If an investor buys shares in just one or two companies, their entire portfolio depends on those companies performing well. Even strong companies can face unexpected challenges such as economic downturns, competition, or management problems. For beginners, diversification can act like a safety net. It reduces the chances of large losses and helps create a smoother investment journey. This is one reason financial experts often recommend index funds for people who are just starting their investment journey. Time and effort. Which strategy is easier? Another major difference between these two approaches is the amount of time and effort required. Index fund investing is simple and passive. Once an investor chooses a fund, they can invest regularly without needing to monitor the market daily. Many investors even automate their investments so money is added to their portfolio every month. Individual stock investing requires much more attention. Investors need to research companies, track financial reports, study market trends, and decide when to buy or sell shares. This process can take significant time and may feel overwhelming for beginners. Stock prices also fluctuate constantly, which can lead to emotional decision-making. Beginners sometimes panic during market declines or become overly excited during market rallies. These emotional reactions can lead to poor investment decisions. Index fund investors typically avoid this stress because their strategy focuses on long-term growth rather than short-term market movements. Risk versus reward. The real trade-off when comparing index funds and individual stocks, the biggest difference lies in the balance between risk and reward. Individual stocks have the potential to generate extraordinary returns. If an investor successfully identifies a company that experiences massive growth, the gains can be substantial. Some investors have multiplied their investments many times through successful stock picks. However, the opposite is also true. Choosing the wrong company can lead to major losses. Many businesses fail, decline, or lose market relevance over time. Index funds rarely produce the extreme gains that a single winning stock might deliver. Instead, they aim to capture the steady growth of the entire market. While the returns may seem less exciting, they are often more consistent and predictable over long periods. For beginners, this balance between stability and excitement becomes an important factor when deciding which approach to choose. Why many experts recommend index funds for beginners? A large number of financial experts encourage beginners to start with index funds. The reason is not because stock picking is impossible, but because it requires experience, research skills, and emotional discipline. Index funds allow new investors to participate in the stock market without needing deep financial knowledge. By investing in the overall market, beginners can benefit from economic growth while avoiding the pressure of choosing individual companies. Another advantage is cost efficiency. Many index funds have extremely low management fees compared to actively managed funds. Over long periods, lower fees can significantly increase overall investment returns. Index fund investing also encourages long-term thinking. Instead of focusing on short-term market movements, investors learn to remain patient and allow their investments to grow gradually. Can beginners invest in both? While many discussions frame the debate as index funds versus individual stocks, the truth is that many investors use both strategies together. For example, a beginner might place most of their money in index funds to build a stable foundation while allocating a smaller portion of their portfolio to individual stocks. This approach allows them to enjoy the stability of diversified investing while also experimenting with stock picking. This balanced strategy can help beginners learn about markets without risking their entire portfolio on a few companies. What actually wins for beginners? If the goal is simplicity, stability, and long-term growth, index funds often win for beginners. They provide diversification, require minimal effort, and reduce the risk of major losses caused by poor stock selection. However, individual stocks can still play a role for investors who enjoy research, learning about businesses, and taking calculated risks. Ultimately, the best investment strategy is one that an individual can follow consistently over many years. Investing success rarely comes from one lucky stock pick. Instead, it comes from disciplined habits, patience, and long-term commitment. For beginners entering the investment world in 2026, understanding the difference between index funds and individual stocks is an important first step. With the right strategy and mindset, either path can lead to financial growth, but the safest starting point for most people is often the simple power of diversified index investing. Thank you guys for watching. If you want more videos like this, make sure to like the video and hit the subscribe button, and we'll see you in the next video.